U.S. economy, big story of the day, adding 143,000 jobs, lower than expected in January. However, the unemployment rate did fall to 4%. Jan Hatzius, Goldman Sachs chief economist and head of global investment research, joins us here at Post 9 on a jobs day. Welcome. It's good to have you. Can we just start with the consumer confidence numbers, because that came at the top of the hour. It was a dip in confidence and a big jump in short-term inflation expectations. And I was just looking at when this survey was done. It spread out over a long period of time, but does kind of encompass some of the time around the tariff drama. So I wonder how much of it is about that.
It does seem partly about that, because there's also some more granular information in the report that shows an ongoing rise kind of more recently. So I do think that there's some impact. Obviously, inflation expectations are still well below where they were in 2021-22, but they have risen pretty significantly. And these are very noisy numbers. It's a small survey, so you really do need to see more information. You probably want to take a very close look at the New York Fed survey that has a much bigger sample that won't come out for a few more weeks. But it is something that deserves attention as a potential indicator of second-round effects.
It's also very politicized in terms, and they do break it down by Democrats and Republicans, and Democrats are much more worried about the inflation situation right now. But if you take this with the wage number that we got in today's jobs report, how concerned should you or the Fed or investors be about a resurgence of inflation?
I think I'm not overly worried. I mean, the wage number, I would actually say I don't put that much weight on. There was a decline in the work week. A lot of people are paid on a monthly basis. And then when the work week falls, you get a mechanical increase in average hourly earnings. There's some evidence for this because financial services and information technology showed the biggest increases in average hourly earnings and a sizable drop in the work week. Also, if you look at other indicators of wage growth, the employment cost index that came out last week, there's really no evidence that we're getting a rebound in wage growth. But, again, there are a bunch of different indicators. You want to put some weight on all of them. And the inflation expectations number caught my attention.
Meantime, there's been, I would argue, a broader mix of discussion about whether rates are restrictive or neutral or close to neutral. Do you dismiss outright the notion that the Fed could hike this year?
I think it's pretty unlikely. I think it's very unlikely, in fact, that the Fed's going to hike. I think at the moment they're quite comfortably on hold. They think rates are restrictive. That was very clear in the press conference. Other Fed officials have said it. But the debate is about how long to stay at this restrictive level. And I think it's going to be, quite a while. We're still expecting a couple of cuts in 2025. But I think the risk is that it takes longer. And, they don't need to really do very much. The economy is still growing at a good pace. We saw it in the employment numbers. Certainly, if you take an average of the last several payroll numbers, we're still actually in the 200s for non-farm payrolls. Unemployment rate's been drifting down. So for now, I think there's not very much to do. With that said, if you look at the inflation, the wage numbers are encouraging. I think labor market adjustment in the JOLTS survey, for example, which came out earlier this week, still ongoing. So hikes, to me, still seem unlikely.
Do you think we mentioned the big government push and the prospect of some government either retirements or early buyouts or even layoffs? Would that move the needle, do you think, nationwide?
I think from a macro perspective, these numbers are still very small. Of course, there is an enormous amount of focus on it. I understand that. But when we're looking at overall government employment outside uniformed military, it's quite a small share of overall employment. So I don't think it's really going to show up in a major way in these numbers.
What about immigration, something that you've been talking about for a while? We did get some population estimates in this new number today. What can you tell about how much that's been adding to the labor market and what might happen now that we're seeing this crackdown?
Well, it's been adding a lot because you go back a year and the break-even rate of payroll growth, the rate that's necessary to keep the unemployment rate stable, was probably well above 200,000. Now, that is coming down clearly. and it will come down very significantly. Prior to the pandemic, that break-even rate was generally estimated to be 50 to 100,000. And, as immigration normalizes, maybe net immigration falls below the long-term trend because we're getting deportations, then, we're going to go back to a much lower break-even unemployment rate, break-even payroll rate.
Yeah.
One thing that's really important here is for people not to put too much weight on the payroll, month-to-month payroll numbers. They're not as useful as they were when we could be sure about the break-even rate, because immigration has been such a big swing factor. We need to really put more weight on the household survey and other measures of labor market utilization than payrolls.
One more final quickie for me on tariffs. And I know we don't know where it's going and whether the delay amounts to anything. We know that China has increased tariffs now. On tariffs, as far as the spillover effect on the U.S. economy, do you worry more about the inflationary pressure or the economic hit, the demand destruction?
That's a really hard one to answer. I think markets have taken a pretty strong view that you should put a lot more weight on inflation. I'm not so sure about that, because if I go back and look at past episodes, including 2018, 2019, it could go the other way. Now, that was a very different situation. Inflation was below the target. Interest rates were also much lower. But I'm very unsure. I think big tariffs, of course, there's a mechanical impact on the price level. And there's also some hit to growth. And I think you need to look very closely before making that judgment.
Jan, thank you. Good to have you here. A lot to talk about. Jan Hatzius from Goldman Sachs.